Thanks for joining this month's investment video. I'm Ross Bramwell, a member of Hammerberg's investment team. Bond yields across the globe have risen as we begin the new year, fueling concerns over government finances and raising the specter of higher borrowing rates for consumers and businesses around the world. The U.S. 10-year Treasury yield touched a fresh 14-month high just this week as investors reassess the pace at which the Federal Reserve, or the Fed as I'll refer to it, might lower interest rates. But the U.S. economy has so far withstood sustained higher rates, even as most expected rates to decline as the Fed began its cutting cycle. In this video, we will discuss a few reasons why consumers and corporations have held up much better than expected with sustained higher rates and what could impact the Fed's decision-making going forward. Bond yields have been impacted by several factors. Investors are now anticipating fewer rate cuts from the Fed than they did previously and are demanding to be compensated for the risk of owning bonds that mature well into the future as they are concerned over large government budget deficits. Last month, the Fed projected just 2 rate cuts in 2025, having previously indicated twice as many cuts. A better than expected U.S. jobs report last Friday has made the Fed's rate cut path more uncertain. Non-farm payrolls increased by 256,000 in December, surpassing the 212,000 added in November and exceeding the forecast of just 155,000. The U.S. economy is strengthening faster than anticipated, which means the Fed has less or no room to cut interest rates. And the bond market is reflecting that new information. Bond investors are sending a signal to the world central banks and governments to get a grip on their budgets. Here in this chart, we see that rates dipped last summer, moving lower from the tan line down to the gray yield curve, the gray line. So that was going from June to September to the first rate cut. However, since then, from the gray line up to the maroon line, we can see that yields across the yield curve have increased significantly. The chances of just a single cut this year increased after the jobs report. Additionally, elevated government deficits are also contributing to the bond sell-off as more debt supply is hitting the market. The U.S. government reportedly recorded a deficit of $129 billion in December, a 52% higher amount of debt compared to a year ago. Higher yields ratchet up the amount of money needed to be spent on servicing debt, especially in the case of governments that run persistent deficits. Typically, you want higher deficits when unemployment is high. We currently have high deficits with low unemployment. The Fed raised its key interest rate to battle inflation. Its objective was to raise rates to a sufficient level that it became restrictive to the economy by decreasing consumer demand, or that higher rates become restrictive so companies slow their hiring, which weakens the employment picture and softens consumer demand in the end. This chart illustrates one element of why consumers have withstood higher interest rates. Housing affordability is a national issue, and we have seen mortgage rates move significantly higher since the Fed began to raise its rates. Here we have the 30-year mortgage rate in gray. However, most homeowners have locked in low interest rate loans, and their housing costs have not changed. Here we see that in the maroon. This is the effective interest rate over time. So the Fed's rate hiking cycle did not necessarily impact consumers as expected. Consumers were prepared with locked-in low interest rate loans, which preserved consumer strength and consumer spending. It is not just governments and consumers that are impacted by higher bond yields. The borrowing costs for many businesses are benchmarked to government bonds. And as government bond yields rise, so do borrowing costs for companies. However, many of the largest public companies in the world have very little to no debt, and they generate lots of cash flow. Therefore, as we see from this chart, total corporate interest payments have declined in recent years, even as yields have headed higher. This is in part because U.S. GDP has remained strong and earnings have surpassed expectations. With the portion of cash flow going to debt service, it has declined. The Fed's rate hikes did not have the slowing impact on companies that was anticipated. Corporate earnings have held up better than expected. The jobs market remains strong after the 2 most recent employment reports. There was some volatility this fall, as we can see from the hurricanes. But if you look at the averages, it is indicative of a labor market that is still supporting a healthy and strong consumer, which is driving better than expected corporate earnings. The economy continues to grow. However, this data does not support additional rate cuts, which is why the Fed has likely hit the pause button on additional cuts in the near term. The chart on the right may be one of the most important charts for the Fed in 2025. We know that job openings have come down, and hiring is in fact slowing across most measures. The crucial factor for the Fed will be whether those who get laid off over the coming months, how long does it take for them to find their next job? So far, the continuing claims have held steady just below 1.9 million. If that begins to move up, maybe it will give the Fed some flexibility on additional cuts. But if the job market remains tight, it may be hard to support additional rate cuts this year. Investors are now awaiting the inauguration of U.S. President Trump next week. The real test comes once Trump takes office, when a big wave of executive orders about tariffs and immigration restrictions are expected. There are many more people now even talking about the potential of rate hikes at some point in 2025 if inflationary pressures build. Given that the Fed has already had to decrease the number of cuts and the pace of expected cuts to a slower path, there is uncertainty about the Fed's decision-making. Inflation remains above the Fed's target, but current levels have not been a challenge for the economy. We have already seen corporate earnings withstand these levels of inflation and even higher. Right now, the Fed is watching employment closely, but its attention may have to turn to inflation as well based on tariff and immigration policies implemented. Thanks again for watching this video. If you have any further questions, please reach out to a member of your client service team.